La inteligencia artificial generativa está transformando negocios y finanzas en forma acelerada, profundizando tendencias de automatización ya existentes en el trading. Los algoritmos ya no solo son herramientas de un trader, sino agentes que parecen competir con ellos y los expertos del mercado financiero. Presentamos la conferencia magistral Evolution of Algorithmic and High Frequency in Gen AI World. Larry Tabb es director de Market Structure Research en Bloomberg. Previamente fundó y dirigió la firma de investigación Tabb Group, donde publicó extensamente sobre la estrategia de mercados financieros. Anteriormente, fue vicepresidente y fundador de Tower Group Securities y trabajó en servicios de trading en Lehman Brothers. Actualmente dirige un equipo de expertos desarrollando investigación e insights sobre el mercado financiero y tecnología. We welcome Larry Tabb to the Risk Management and Trading Conference 2024.
Thanks for that. Very happy to be here. It's been a while in the making. I want to thank Alan for inviting me for so many years. Finally, I've actually been able to make it. And Sylvia Davi for also getting me down here. And it's been very worthwhile. Give me 2 seconds. I think I'm looking for a clicker. There we go, finally. Good. I'm going to talk a little bit about the evolution of algorithmic trading, high-frequency trading, and how AI kind of fits into this. There we go. I work for Bloomberg Intelligence. That's the research arm of Bloomberg, LP. That reports into the news side, so it really is independent, and it's been a lot of fun. I've been here for about 5 years, and you heard my history, so no need to go into that. I'm going to talk a little bit about what is algorithmic trading and high-frequency trading. How did we get here? Kind of a little bit about what the U.S. markets look like and why high-frequency trading is really just become trading. And kind of how this whole thing fits together. And it's really about segmentation and speed. That's really the whole core of what high-frequency trading is about, and why computers really really run our markets these days. Then I'll start getting into AI and where AI fits, because a lot of the algorithmic trading really isn't AI. AI is only kind of being an overlay now. And we'll talk about regulation and how things are changing, and some conclusions. So algo trading and high-frequency trading, I kind of break it into 3 really different portions. One is market making. So being able to put up quotes. And the reason why, I'll get into the reason why speed is so important in terms of putting up quotes in a little bit, but basically the US market has 16 different exchanges, 30 dark pools, and a bunch of different market makers. And to a certain extent, you need to keep your eye on everything, and data is moving at such fast speeds that you really need to process a tremendous amount of data just to put up a quote, so that you're not getting picked off. So the first aspect of high-frequency trading, and really what most people think of high-frequency trading, is in the market-making space. And the reason why the market makers need such technology is for the second type of high-frequency trading, which is opportunistic trading. And that is really looking at all the market makers' quotes and picking them off. So when I put up a wrong, when my quote on Apple, or my quote on IBM, or my quote on Amazon gets stale, someone is going to pick off that quote because my quote is wrong. And so it's a constant battle between the people trying to put up quotes and the people trying to pick them off. And that's the kind of the balance that gets your price discovery opportunities going, and that's really where the battles are. On the opposite side of that, there are real investors that are actually trying to get trades done. And they're trying to scan the liquidity profiles of all the different vendors and where a trade's going off. And that's kind of the third aspect of high-frequency trading, which is really more algorithmic execution. And that's really where the buy side comes in, and that's where the investor sides come in. And some of these also overlap. So the market makers don't only provide liquidity, but they also, they're also picking off other stale quotes as well. So it's not all one versus the other. I like to look at investing and trading as a timeline. What is your time horizon? And different people play in different spaces. So your market makers, are basically in the subsection to a minutes play. So there you've got the people putting up quotes. You've got the opportunistic guys trying to take out stale quotes, and that happens now in microseconds, milliseconds, or microseconds, or nanoseconds, microseconds, and milliseconds. And then you've got the next space is really your stat arb folks, and what they're trying to do is take a look at like the S&P 500 or different indices or different trading products, and trying to understand the components of those trading products and trying to analyze them compared to the index or compared to the option or the future or some other set of products. And they're really trying to keep the values of those together, and when they come out of line, they'll buy the cheap one, sell the expensive one, and bring those prices back together. And that's happening kind of more in the second area to minutes area. And then when you start getting into the hours to weeks, you start getting into the hedge funds, weeks to months. You're also getting into the hedge funds, and you're getting into the traditional asset managers trying to figure out investment strategies. And then you've got the folks that are holding from months to years. And I kind of think of them as Warren Buffett, the guys who buy and never sell. But that said, Warren Buffett sold a whole lot this last month or two, so I'm not sure he's the best example. But you've got people that are really long-term holders and people who really want to own those names over a very long period of time. And the game is trying to, the game is moving, and it's moving incredibly quickly. You've got, the market makers, the opportunistic traders, and really the long-only managers. Some are trying to capture a spread, some are trying to capture a rebate, some are trying to pick off other people. So you've got all these people, in effect, shooting at each other, trying to make a profit off everybody else. So speed becomes incredibly important. And then you've got to understand the venues. All the different, we have 16 exchanges in the U.S. We have 30 dark pools. We have a bunch of different, in Europe they call SIs, or in the U.S. they call single dealer portals that provide liquidity directly for very individuals. But each one of these things are unique. Each one of these are very different. You need to understand what are the rules, how do they operate, and what's the infrastructure like to better understand how to play in that infrastructure and find liquidity and trying to do so without getting picked off. So how do we get here? When you go back a bit, you've had two types of models. You've generally had an exchange model where you had investors talk to a broker. That broker would then go to like the New York Stock Exchange or an exchange, and then there would be floor brokers. There would be someone moderating the trading, and it was kind of an auction-like situation. You go up and say, hey, look, I'm a buyer of this, I'm a seller of that. You'd find liquidity, and the trade was done. On the other hand, you had over-the-counter type markets where you had a network of dealers. Investors, again, would go to the broker, but the brokers would more negotiate. When you go back 20 years, you had folks like NASDAQ that we think of NASDAQ being an exchange, but NASDAQ was really more a market data infrastructure. The quotes were disseminated out to the market makers, the orders would go to the market makers, and you actually had to pick up a phone to trade. If you go back to the 90s. And so it was really more of a phone-based over-the-counter type market. Eventually what happens is the different venues wind up submitting quotes. The different players submit quotes. Those quotes come into together. They battle it up. The best bid, the best offer come. They become the top of the book. You wind up with an inside price. and you wind up with an order book on a montage. So when you look at the US market, this is really kind of simple. Here you have 4 SIBO books, but really there's 16 exchanges. They're all providing bids and offers and quotes. They all have a top of book. They all get different orders. Some orders are better priced at one exchange than the other. Some are priced better at the other exchange than one. And then what happens is all of those books, all of the best bids, all the best offers then get aggregated, generally at the broker level, to try to understand how do I execute across all this fragmented environment. And then what happens, an order comes in, they'll take a couple of shares here, they'll take a couple of shares there, they'll take a couple of shares there, and weave this all together and kind of glue what used to be one single exchange where I would go to execute, glue all this back together. And so when you look at this, how did we get here? You've got to look at different milestones. The milestones to really kind of build this market come out of 5 or 7 different major regulatory initiatives and different things that occurred. The first thing that really happened was really back in the 1990s. The internet came online. The internet is really the start of this. It's really, the ubiquitous network. It used to be when even if you go back to, the early 1900s, everything was if you looked at the lower Manhattan, it was one string of communications lines, just telephone lines covering the whole sky, because in effect, everybody needed to come in over physical lines. They needed to get their orders to the New York Stock Exchange, and those orders then would get to the floor and get auctioned off. Online brokerage, and the cost of those telecommunications lines were actually very expensive. And the cost to the infrastructure was very expensive. And so if you wanted to create an exchange, it was expensive to put up a different exchange because getting people together, getting the communications lines, distributing the market data, getting the whole infrastructure was incredibly expensive. The internet came online, and now all of a sudden everybody had access to the network. So cost of telecommunications came way down. The cost of technology came way down. Commissions came way down. You started, in the 90s when Schwab and Ameritrade, Daytech, and all these other players started coming online. And they started driving the cost of commissions down and trying to create a more competitive marketplace for actually retail brokerage. So that's really the first step. Then out of the 87 crash and issues around the 90s, you had the order handling rules. The order handling rules really forced the brokers to post limit orders in where people could display them. Before, New York would have the limit orders on their book, but on the NASDAQ side, the limit orders would sit on on basically the market maker's desk. The order handling rules stopped that, really forced those limit orders back into the market. Putting those limit orders back into the market created a whole network of ECNs, electronic communications networks, alternative exchanges, what we can call them. And that then drove Reg ATS, which then tried to regulate these alternative exchanges. And that created a fragmentation of liquidity and started really putting technology into place to start executing. The next major milestone was decimalization. That moved from fractions to pennies, and all of a sudden, the brokers didn't have the spread to work with to kind of create, big wide markets. Reg NMS came in, created a set of rules around sub-penny, order protection, trade through, all sorts of rules. The New York Stock Exchange became public, and that started a wave of opening up exchanges from member-based networks to public companies. And then we had the globalization of this whole world. And when I talked about kind of the old versus the new, this is kind of an older slide I've used before, but it kind of gets to the point. When I think about where we were, the exchange, in effect, the exchange was one big order management system. I'd call the floor of the New York Stock Exchange, or I'd call my NASDAQ broker, and they would fix it. They would get it executed. They would get me done. How it got done, who the hell knew? But it got done. Sometimes you were happy, sometimes you weren't happy, but all of the matching logic happened on the floor of the exchange. Now we move to today, the right-hand side of this chart, the blue side of this chart. And what I say is we have a fat execution management infrastructure. Basically, algorithms drive the market. The execution management, the algorithms kind of figure out where to route each order. You've got exchanges, you've got ATSs, you have different players. They're on the right. And the execution management, or the algorithm, figures out, do I go to exchange 1? Do I go to exchange 2? Do I go to ATS 1? Do I go to ATS 2? How do I find that liquidity? And today, we've got 16 exchanges. We've got 4 new ones on the way. We have 24 Exchange. We've got Texas Exchange, Green Exchange, Dream Exchange. Basically, in another year or two, we're going to have 20 different equity exchanges. Right now, there are 17 or 18 options exchanges, 18 options exchanges. Tremendously fragmented. Most of them have real-time order books. That's kind of on the left. On the right, you've got IEX. That's a speed bump in the middle of that exchange building. They have a speed bump. But you're going to see different types of markets. On the ATS side, you've got block ATSs, ones that try to create, find big orders. You've got algo ATSs, basically a lot of broker dark pools that are there. A lot of the brokers use them not to send orders to exchanges so they can save on exchange fees. And now increasingly you've got discontinuous ATSs, ones that don't necessarily operate in a real-time order book. Intelligent Cross, PureStream, One Chronos. You've got venues that have speed bumps or other types of auction mechanisms in them. And then on the right, you've got market makers, STPs or SIs, which you call them, Jane Street, Virtu, Citadel, XTX. There are half a dozen different players in this market where you can go directly to them and they'll give you a price. When you look at how the markets operate, the top green line is exchange market share. And you can see that's going from 90% down to about 54% today. This is over, 20 years. The exchanges have lost market share, and they continue to lose market share. The blue line coming up from the bottom is over-the-counter trades. And so that's up to now 46% of the market. And so you've got these are ATSs, these are the single dealers. We'll talk about them in a minute. And then you've got each individual exchange group. So you've got New York at about 20% market share, NASDAQ at about 17% market share, CBOE at about 10% market share, and the 4 or 5 different independents sharing about 5% market share. This is kind of how it looks in terms of each different venue. And you can see there's a ton of venues with just not a whole lot of average trading volume, but they still exist. They still operate. But you've got 3 or 4 major exchanges. You've got NASDAQ, you've got New York, you have New York ARCA, you've got BATS BZ, you've got EdgeX, and then look on the right. That's all the over-the-counter side. And the over-the-counter side is split between 2 major groups. You've got the ATSs, which is about 11%, but the real volume, that 36%, that dotted yellow line, is over-the-counter. And that's where really the crux of the volume, a lot of that is retail. And so when you look at that market, what does it look like? You've got Citadel, you've got Virtu, you've got Jane Street, G1 Execution, which is really tied to Susquehanna, HRT Financial at about 6%. You've got Morgan Stanley, that's the first, traditional market maker, 2 Sigma, Goldman Sachs. These are like the top, 10 or 15 players. So 83% of that are high-frequency type firms that most people have never even heard of. Only 13% of that 40%, or really the 36%, are traditional market makers, the ones that Goldman Sachs, Morgan Stanley, JP Morgan, Citigroup, the big players. So what's going on here? All this fits into a complex structure. There's a whole network effect. How do the orders get to the market? And this is crux in terms of high-frequency trading. How do the orders flow? Who gets that order first? who intermediates it, who gets first look, what do they do with it second, what do they do with it third, does it go to a dark pool? And then generally it filters through. Retail will get taken by a wholesaler. That'll then get opened up to a wider group. That may wind up in an external dark pool, or maybe even a third external dark pool. And then finally it may go to an exchange. It's a whole level of waterfalls and knowing where you are in that place is critical to how you provide quotes, how you price things, how you get executed. So again, retail investors go to a wholesaler, they get the first look. The first look is incredibly important. That's why you see folks investing in wholesaling markets. That's why you see single dealer platforms come up. That's why you see market makers and SDPs kind of crop up. They want to get the first look at that. They want to get and that's where speed and price and everything comes together. And that's what they're trying to do, is get the first look at that order. Not necessarily because they want to trade it, but they mine the information. They can understand what's happening with that order flow. And think of it as almost an option. The first person who looks at it is the guy with the best option to trade against it. Because if you're second, the other guy passed on it already. And if you're third, 2 guys passed on it already. And if you're fourth, 3 guys passed on it already. And by the time you get to the exchanges, a whole bunch of people passed on it. So while this whole infrastructure may actually be good for the investor because you've got all this competition, when you get down to the exchange level, it's like yesterday's news. Everybody has looked at these orders and decided, nah, let Mikey have it. Let some other person, execute that. And so the pricing on the exchanges tends to get worse. So how do we look at this? This is data from the different market makers. And what all of this segmentation is doing is it's basically enabling them to provide better pricing for their retail client. And right now, on average, that's the top line. The retail investor is getting 47% price improvement, and that's between the midpoint and the bid or the midpoint and the offer. So they're getting basically half the spread they're capturing. 15% goes to payment for order flow. That's a payment that goes to the broker. It averages about 11 cents per 100 shares. It's not very much. And the 38% is the potential for the market maker to keep. And that doesn't even include technology. It doesn't include bad trades. So this works out incredibly well for individual investors. And so that's the play. So we talked about speed. What is the story with speed here? Speed really is about rebates, and it's about exchange fees. So I did this in October 2020. It's a little different. I wouldn't say it's completely up to date, but it's a good view of the different 16 exchanges and kind of how they price. The orange bars up top are rebates, and you can see if I provide liquidity, the orange bars are actually providing liquidity. The left side basically are rebates, the right side are fees. At the 3 largest exchanges, I'm getting 31 cents per 100 share rebate, 29 cents per 100 rebate, 28 cents per 100 rebate. And then on the far right, the orange fees, the orange bars down, those are the fees. So so in effect, by providing liquidity, I'm getting a rebate. By taking liquidity, I'm paying a fee. So what happens is all the providers line up on the right, and all the takers wind up on the left. And it's a battle for who comes into the center and how they actually meet. Who's going to cross that spread? And all I really need to do if I'm an investor, so to get to the top of the queue, all I need to do is take a little bit less of a rebate or pay a little bit more in exchange fees. And I can wind up, in effect, not necessarily playing with all the fastest people, but what that also then does is it signals that the price might not be right. So there's this battle of trying to get the largest rebate, pay the least fee, trying to find the buyers and sellers, match them together without signaling that, yeah, there's somebody who's willing to pay more than the bid or the offer. And this is kind of the crux of how a lot of the exchange works. Rebates for adding liquidity, basically paying the least amount of fees to take liquidity, and that's what that's about. And so if you think about it, I think about it as a bunch of buoys in the water. Each exchange is a buoy. You read the tape, you see how people are traversing liquidity, and that will then tell you whether the price is going to go up or the price is going to go down, depending on how that liquidity is being pulled off the book. Again, you wind up in the US, the exchanges are in different places. You've got Carteret, which is the bottom of this map. That's where NASDAQ is. You have MAWA, which is where the New York Stock Exchange is. And you have SIBO, and most of the different broker-dealers are located in Secaucus. And the distance between that triangle, as well as the Flash Boys line that goes all the way out to Chicago, the CME, which is now the Flash Boys line is kind of yesterday's news. Now it's all microwave, and a lot of this triangle is now microwave, is trying to understand this liquidity and how do I get to the different venues and what's it going to take. And that's where the IEX speed bump comes in to try to obviate, basically get rid of the issue around speed, and that's kind of why all this fits. And if you look at the amount of data that goes on here, it's a phenomenal amount of data. So just on an average day, I pulled this off the Market Data Peaks website last week when I did this slide. Basically, the peak data or peak messaging rate is roughly 20 million messages per second, consistent over a full minute. And you can see, on almost every single day, they're hitting 20 million messages per second over consistent 1 minute. The burst rate is 44 million messages, and that's the historical high. And so you need to be able to process. Now, this is also options, which is where most of this data is. But there's a tremendous amount of volume going on here. This is from the SEC market structure website. It's basically saying if you look at large caps, 15.35% of large cap trades are executed within 1 millisecond. And if you look at the below, 20% of large cap orders are being canceled within 1 millisecond. That's huge. It's just so there's a tremendous amount of volume just really happening within 1 millisecond. And if you extend that to 10 seconds, 73% of large cap stock trades are executed within 10 seconds, and almost 91% of large cap trades are canceled within 10 seconds. So you need, if you're going across these 16 exchanges and dark pools and whatever, speed is incredibly important in the technology to do that. SEC has been very active. Gensler has been lined up against trying to do this. He put out a whole bunch of market structure rules. There were basically 4 major market structure rules. He hasn't been very happy with how all this fits together. He wanted to provide transparency into retail execution. That actually turned into a rule that was passed a couple of months ago. Now we're talking about reduced tick sizes. They want to go down to the original proposal was 4 different tick sizes: 1/10 of a cent, 1/20th of a cent, 1/5, a half a cent, and a full cent spread. We don't think that's going to happen. There was an article today where the IEX guys say they think that they're going to have an agreement on this in place before the election, which will be interesting. Then they wanted to create retail orders, retail auction orders for every retail order that came into the market. That probably won't happen. And then there's they want a best execution rule, which also may not happen. There's been a lot of lawsuits about this. I want to talk a little bit about AI. So what is AI? You've got all this data, you have all this infrastructure going on, you have all these algorithms certainly moving way faster than people can actually push buttons to trade on. Is this AI? Most of this is not AI. Most of this is traditional statistical analysis that goes on. And to a certain extent, we'll talk about this in a second, you can't really use AI to be at the very front lines of execution because the market just moves too fast. AI, basically when you're going out to so many places, becomes very difficult. Now you can use AI to try to, determine parameters to trade but you're not going to see the market makers, migrating to AI to determine where to put quotes. That said, you do see hedge funds start and more traditional money managers using AI to figure out the market, and we think that's going to be the really sweet spot. And you can see AI starting to move into investment. We also see AI kind of moving to try to help analysts understand the market better, synthesize data, synthesize news, synthesize all sorts of information to help me make a decision on what to do. Can AI trade? We don't see AI, in this market maker space. That said, once you start getting out of the sub-seconds to minutes and you start getting into minutes to hours and hours to weeks, we see AI playing in that space much more effectively. Now, when you have generative AI, that's a little bit more challenging to use for investing. Try to make sure you don't have hallucinations going in, training the data. Increasingly, you've got data behind paywalls. My company is notorious for trying to keep stuff behind paywalls. Some models need constraints. But as the tools get better, we expect this all to get better. And in fact, there was a research paper that came out yesterday about that. I'll talk about that. The other thing you need to worry about is, are the AI models following trading rules? Because if you let an AI on just to analyze information, it will learn pretty quickly that it can make money if it spoofs or tries to manipulate the market, and you've got to try to make sure that your AI models don't do that. As I said, there was a new study put out yesterday, large language models, agents in financial trading, a survey by Ding, Yang, Li, and Chen of Columbia University. They kind of break it into finance, as a trader versus an alpha miner. Now, when they talk about trader, they're not talking about millisecond and microsecond trading. Their data set goes really, they're looking at one-day periodic data. They're really not looking at that. That said, there's a lot of models out there. There are challenges. There are privacy issues. They need to be fine-tuned. You've got latency issues. Trying to find liquidity is issues. Trying to figure out integration with existing trading systems. There are a whole bunch of issues that this study kind of highlights. And if you're into it, I highly recommend reading it. We expect AI to kind of start in the retail space, in the robo space. You've got robo advisors now. Most of them are not AI oriented. They're more predetermined portfolio models that they put you into. We think that this will be one of the first places that AI starts really kind of meeting individuals. Will this happen? We think this will happen fairly quickly, within a couple of years. Do we think that we're going to wind up getting Fidelity to start investing your money, my money, via AI models? Maybe the hedge funds, certainly private funds. I think it's going to take a little bit of time. That said, compliance is going to be a big issue. And certainly AI is going to help investors make decisions. It's going to digest news. It's going to digest research. It's going to digest all sorts of things that are available on the web. And you're going to get cleaner data. You're going to get the LSEGs and the Thomson Reuters train models on their data. Bloomberg, we're creating a GPT for Bloomberg. Not that I've seen it. But they tell me they're working on it, and this is going to get opened up to more and more players, and so you're going to see folks try to monetize their content and play in here. I think you're going to see this grow pretty significantly. On the other hand, you've got the SEC that actually is trying to go the opposite way. They put out a proposal called PDI, Predictive Data Analytics Rule, and to a certain extent, what they said, well, how do I go back here? Whatever. What they said was that anything that touches a computer that goes out to an individual or an advisor is going to be subject to conflict of interest rules. And the conflict of interest rules, traditionally the SEC regulates conflict of interest rules around disclosure. So if you have a problem, you've got to disclose it to your clients. You have to put it on a confirm, you have to put it on a screen. The predictive data analytics rule basically said, no, you either have to eliminate this conflict or you need to neutralize the conflict. And nobody can actually tell me how to neutralize a conflict of interest. So basically, it's eliminate a conflict of interest. So what does that mean? So here you've got a stock chart of Apple. That's okay, that's historic data. But as soon as I put a trend line on it, that could, in effect, give someone the view that, hey, I may want to buy Apple or I may want to sell Apple or whatever. And then that becomes a conflict because, in effect, I'm offering brokerage services that may get me a commission, that may get me payment for order flow. So I'm going to generate money off that trade. And so now I have to, that creates a possible conflict. And it has to be addressed at the board level on an annual basis and quarterly within the groups. And it becomes incredibly headache. So it means even putting trend lines on a chart, top stocks, any type of news, any type of research, all of this can in effect be thought of as providing incentives to trade. And so completely unworkable. In effect, the SEC has kind of pulled this. Conclusions, and then I'll take a couple of questions. I think I got five minutes or so, or 7 minutes. If we go back to high-frequency trading, high-frequency trading isn't a boogeyman. If you've read Flash Boys, which I'm actually quoted in, the book is completely wrong. Let's not get into the book, but basically high-frequency trading these days is just trading. You've got millions of data points that need to be analyzed, on a microsecond basis. You've got 16 exchanges, soon to be 20. You've got 30 dark pools. You've got half a dozen different market makers who will provide you a quote on the touch. You can't do that by hand. There's just no way you can do that by hand. So what's the alternative? I'm going to go back to paper tickets on the floor of an exchange. So high-frequency trading is just trading. You're going to, this relies on a lot of high-speed information. A lot of this in the fragmentation is really about segmentation. And to understand high frequency, to build algorithms, to build models that work in the market, you need to understand the latency of the different exchanges, how far you are from the data centers, what kind of liquidity profile, what's the pricing, how do orders flow through the market, trying to get to be the first person to see that order so that you can, in effect, have the optionality of pricing. The regulators are stepping in. They're trying to, in effect, change this whole model. It's been very effective in the retail equities markets. That said, the SEC has not been able to pass a whole lot of these rules, and we'll see whether they do so before the administration changes, because it's going to change one way or the other come January. AI is going to be an increasingly larger portion of the market. We are, as I said, trading is just using technology. So that's just going to continue, and new technology tools are going to just mean new ways of ingesting data. How is AI going to be used? Today it's going to be used really trying in the longer term trading universe, not into the microseconds and seconds world, but really in the minutes to days to weeks to months world. And that's where we see AI, at least in the current market, being the most important. But the question is, how will regulators step in? Because even though the predictive analytics rule is going to be reworked, you really do want to make sure that if you're using a robo-advisor that's AI based, that it's not trading on behalf of the brokerage firm and not you. How you do that, that's above my pay grade. That said, we've got 4 minutes, take a couple of questions. If not, we'll pass it on. And I want to thank you again. Thank Alan and Sylvia for having me, and RiskMathics. Thank you.